What's going on YouTube? This is your boy Manny with Money with Manny 101. On this episode, we are going to cover compounding interest. I've been trying to drag out the investing portion because I always think that you need to be better with your money before you start investing. But it does also make sense because of compound interest to start the first lesson when it comes to interest or investing as well. So if you haven't yet, please make sure you like, comment, and subscribe. Share this video with somebody that wants to start investing. That way they know the basics and understand why investing and essentially how it works when it comes to making money. So what is compound interest? That is very simple. Compound interest is just the interest earned on an original investment plus the interest earned on the interest that has accumulated over time. So essentially, as you can tell in these two graphs, when you have simple interest, which is just the same interest over time, you have a straight line that goes up, while compounding interest essentially doubles that straight line. If we were to draw compound interest here, it would essentially surpass the initial investment plus the interest. With that being said, if we had an initial investment, let's say Bob and Joe had an initial investment of $1,000. Bob decides to put his investment in the stock market or something that compounds, that has compounding interest, while Joe decides to put his $1,000 in something that has simple interest, which essentially just gives you the interest on the initial investment. After year one, Bob will have $1,100 and Joe will have $1,100. That is because at the first year, the only thing that was compounding was the initial investment. Now you look 10 years down the line, Joe has $2,000 now because his 10% interest, which is $100 every year, ended up doubling his money. Now Bob has $2,593. That is because every year his interest increased because it was not only being applied towards the initial investment, but it was also being applied on the interest that he earned on that initial investment. So at year two, the interest was applied to $1,100, and at year 10, it's going to be applied on $2,593.74, compared to Joe, which his $2,000 investment will still earn a 10% interest only on the initial $1,000. Now the difference happens and starts becoming very noticeable over time. So if you look at year 40, the same $1,000 that was invested in year one is now $45,259, while Joe's $1,000 is now $5,000. This is the reason why I decided to make this video, because compounding interest works best with time. So if you're 28 like me and you don't have too much to put into the stock market, it is very smart to still put something and add investments over time or recurringly, which is why I have a strong push on the 401k. What I'm gonna do is link a couple of my videos that I have that previously talks about investing your pre-tax dollars to take out later on. This essentially what it does with the 401k and retirement plans is it creates a compound interest and an investment into your future that you don't see. So essentially you're thinking that you're putting $1,000 in, while 40 years down the line, that same $1,000 that you put in this year could be $45,000. That concludes my video. If you did like the content, obviously like the video. If you didn't like the content, hey, what the heck, just like the video. It won't hurt or change your life. Comment and share this video with somebody that will learn from it. And hopefully we continue to elevate, and I'll continue to show more videos essentially that has to do with investments. That way everyone has a strong base and understands what they're doing when it comes to buying index fund, mutual funds, or even going into single stocks and betting on Coca-Cola, Apple, or whatever it might be. That's a wrap. One take.